Okay, well, I think we might as well go ahead and get started in the effort of being cognizant of everybody's time. So welcome everybody. Thank you for joining us today. If you're just watching as a participant, we'll just ask you to keep your microphones muted throughout the presentation. If you want to turn your camera on, great. It's not a requirement. Sometimes it helps with bandwidth if you leave it off. So if you want to share your face, that's cool. If not, we're totally cool with that as well. If you have questions throughout the presentation, just put them in the chat and then we will get to them at the end with Brett. A couple of quick introductions. So online today you have myself, Jessica. I'm the assistant manager with Farming Forward, basically just here for tech support. We're going to listen to Brett do all the chatting. And on the back end as well, you have Deanie, who's our extension and communications coordinator, and she'll be helping monitor the chat and with the tech issues and that kind of thing. So if you have any issues, hearing anybody, all of that kind of stuff, throw those in the chat too, and we'll do our best to try and help you out with that as well. And without further ado, we're going to let Brett, who's the product coordinator for the Livestock Price Insurance Program with AFSC, take over and dive into the presentation. So I'm going to turn it over to you, Brett.
Perfect. Yeah, thank you very much, Jessica, and thank you very much for having me today. Excited to chat and talk about LPI here today, and hopefully give everyone a little bit more knowledge on the livestock price insurance side of the program. So, the title of this presentation is managing market volatility, which is something that we are all familiar with over the last few months here. So I wanted to, before we dive into the basics of LPI and what LPI is and looks like, I wanted to show a bit of background where we're at. So this is the August feeder cattle futures that we saw back. It goes back about 6, 7 months there. So where we're at last week when I took this snapshot, we were around that 355, but we've been on quite a bit of a roller coaster ride the last few months there. That large peak in the middle there, that was around the middle of October, and then 2 weeks later we hit this. So we saw a dramatic move from multiple geopolitical factors where we saw announcements of Argentinian beef being imported into the US, New World screwworm out of Mexico. So it can take little news like that to make a market move quite a bit. So that's just an example of how volatile things can be and have been the last few months here. This is just a chart of what our feeder settlement is. So this would be our data that we use to settle the LPI program. So this is tracked over about 25 years, looks like here on this in this chart, and it shows. I just wanted to highlight a couple of these big moments. So this is where we're at right now. That move that we saw on the feeder futures is kind of reflected in this settlement price locally as well. This was what the chart looked like back in 2015. This would have been the end of the last run up there that we saw in 2014 when the last time the market turned around. And then this, I just wanted to highlight this as well. It doesn't even look that severe, but this is the BSE crisis that we saw where we saw that large drop and then sustained low prices for the next 10 years there. So lots of volatility right now, lots of peaks and valleys on these charts. So wanted to highlight that before we dive into how you can protect your operation against some of this volatility. So we'll start off with the LPI basics. So and we'll talk about how LPI works. So LPI is price insurance for your calves, feeders, fat cattle, and we do hogs as well. It was built as a response to the BSE crisis in the early 2000s. It was the first pilot project went live in 2009, I believe, and it was first fully offered on the Fed side of things in 2010. It was built in conjunction with industry to aid producers to mitigate risks that were most present in the Canadian cattle markets. It is 100% producer funded. So producers that pay your premiums, they go into the pot to pay out any indemnities. So it's a 100% producer funded program. It's market driven, so it follows. We use market fundamentals to ensure that we're forecasting accurately. and ensuring that we're trying to forecast the market as best we can. And it's a forward-looking price insurance for future cattle sales. So it's a way to protect your bottom line for any potential future sales that your operation would have. So in a nutshell, LPI is a floor price. So it's when you buy an LPI policy, you're establishing your floor price. So the price that you purchase for coverage is the bottom of your market. If the market goes lower, LPI will pay the difference. And if the market goes higher, you'll be able to sell the cattle for more money. So there's no limit to the upside. If you had a futures contract or like a forward contract, I should say, then you'd be limited from the upside. But with LPI, there's no limit to the upside if there is any there. So why should you use LPI? There's three main risk factors that are present in our Canadian cattle markets. First one obviously is price. So we have that one as a major point. Currency, because we are so dependent upon trade for our industry. Currency is the next major risk factor, and then basis as well. So the difference between our market and the U.S. is can have quite a dramatic swing, and we've seen some volatility in the basis over these last few months as well here with U.S. prices climbing and our prices staying fairly static on certain times of the year and vice versa. So there can be a lot of basis risk as well. So LPI takes all three of these factors into account when we calculate coverage. So just the bare bones, what is composed of LPI? So the coverage is your floor price or the price that you're insuring. So on this screen, it would be this 436 on this example table, would be your coverage. Your premium it is reflected in dollars per hundredweight, not dollars per pound. Um, your premium is what you pay for the coverage. So on this one, it was 11.24 a hundredweight. So and then at the end of the policy, there's a settlement index. So the settlement index is the calculated number that determines if you got paid out or not. And on this example, it was calculated at 486.29. So that's where your settlement would come from. So it's in a nutshell, it's a regional. You're insuring for your regional market price. So whatever region you're insuring, whether it's Alberta, the Alberta index, or a Saskatchewan, Manitoba index, you're insuring for your regional market price. It does not guarantee individual cattle prices. You're just insuring against the regional market price. It helps eliminate severe losses to the policyholder, but it does not force you to sell on a specific date. If the market goes lower than your coverage, you would receive an indemnity payment. Um, but if you decide not to sell because the market's gone low, there's nothing that forces you to sell. You are allowed to retain the cattle if you feel that it's better suited for your operation to do so. And then you're insuring the market for a specific time frame. So that would typically be when you're most likely to sell your livestock. Um, but it does not serve as a contract or marketing tool. So you're not locked into having to sell or having to do anything. You're just insuring the price. So we'll talk about where we get the coverage from. So this is the main coverage component. So we have the three main cattle products: the calf, feeder, and fed program. The class of cattle that goes into the coverage data for the calf would be anything that's 550 to 650 pounds. Feeder would be 750 to 950 pound animals, and fed would be your finished weight cattle. Your cattle do not need to fall inside of these weight ranges. It's an index-based program, so if you sell calves lighter than 550, you can absolutely insure on the calf index. Just know that the prices that will be represented will be representative of a 600-pound calf and not the weight that you'd be selling at, but you'd be able to still use the calf product as well. If you're not inside the weight range for feeder, you can use that as well. Just know that it's an index-based program. The components that go into the fed and feeder program would be the cattle futures. So we use feeder cattle futures for feeder and live cattle futures for fed. We do use the Canadian dollar as well as a basis component. And then for calf, because there is no calf futures, we use the CME feeder cattle futures for calf as well. We use a basis, but then to get it down to a calf price, we use the calf to feeder spread, which that comes from our settlement data that we get. And then we also use the spot barley price based on the Lethbridge barley price to establish the calf coverage. For policy lengths for calf, we offer 16 to 36 week policies, feeder 12 to 36 weeks, and fed 12 to 36 weeks as well. There's two regional indexes for calf and feeder, Alberta and Saskatchewan, Manitoba, as well. And then the Fed program only has the Alberta-based index. So to break down each of these components, so we'll start out with the CME, the Chicago Mercantile Exchange. So this takes we do rely on the U.S. market for kind of establishing some of these futures prices because we don't have our own futures market here in Canada. So we have to use the CME futures to establish a forward price. So we try to we the CME offers standardized forward traded monthly contracts, and we match that to the policy length. So the 12 to 36 weeks would be reflective of around an expiry for a futures contract. We take prices from the first posted close when we rate premiums, so that would be around noon Mountain Time. And this would give us a price forecast for each policy length in American currency. So that's the first step is to find a forecasted price in American currency. The next step would be to take into account the exchange rate. So we have to convert that American price back to Canadian. And to do this, we look at the forward exchange rate that's closest to expiry. So when we're looking at, an October expiry, we're going to try to use the October future dollar value or as close to that as we can to get the most reflective dollar value. Then this will have given us the price forecast for each policy length in Canadian currency. The next component would be the basis. So our basis definition is the expected difference, the basis difference. So we use spot price between the US and Canadian markets at a defined point in time. Forward basis is the forecasted future value of the basis at the expiration of the policy. So it's meant to capture the expected transportation costs and some regional demand. So basically, the basis is just a way that we can convert that forward U.S. price in Canadian dollars to a more regional Canadian number. We use the cash to futures basis and we calculate it weekly. So when we sell our policies 3 days a week, we have the basis that is calculated every week on Monday. The basis estimate takes into account both historical and current data, and we try to match the policy settlement for when we use that historical data. So when we have an October expiring policy, we'll use historical basis data from October's past to give it a more historical value. We then add the basis to that currency converted forward price, which then gives us a localized price forecast for each policy length. And just because calf is a little bit different, because we don't have feeder futures for calf, or we don't have futures for calf, we have to use the feeder futures. So to make the feeder forecast apply to calf, we will apply the calf to feeder spread, which comes from our auction market data, as well as the current barley price. And this will come up with a forecasted average Alberta cash price. So we're trying to estimate what the average price for a 600-pound steer or 850-pound steer in Alberta will be in a future time. After we have that future price, we then offer insurance against it at roughly 95% of that forecasted price. So whatever the forecasted price came out to be, we take 95% of that, and that's what roughly would be the top coverage. We round it to the nearest even dollar, up or down, and that gives us the top LPI coverage for each policy length. We offer coverage 3 days a week, Tuesday, Wednesday, and Thursday. The basis components are calculated weekly on the first day of the week, and the settlement index is also calculated on that first day of the week, and it's based off of the auction market data from the previous week. This next slide talks about how markets move and how market factors can affect LPI coverage. So Just to give an example, we'll talk about the calf coverage. So if we take a look at these fundamentals, so the CME feeder cattle futures, if it were to go up or down, you can see that it would have the same impact on calf coverage. If futures goes up, you can expect calf coverage to go down. Or sorry, if you have futures go up, you can expect the calf coverage to go up. Um, and then same thing, if the futures goes down, you can probably expect calf coverage to go down as well. Um, for our currency, if our dollar goes down compared to the US, we can expect calf coverage to go up and vice versa. If barley goes down, we can expect our calf coverage to go up. And then if the feeder to calf spread goes up, we can expect that calf coverage to go up. So, and just to note, this is just a simulation of what can move LPI coverage, and it's not codependent. So, any one of these factors can have its own impact on the price. Premium rating. So this is how get the premiums for the coverage. So when we look at the futures, we use the forward cattle price to um, the only forward looking price for cattle is the Chicago Mercantile Exchange. So we take the futures price into account. The life of the policy is also used, so longer policy lengths will have a higher chance of the settlement price being below the insured price. So typically, longer policies have higher premiums because it's so far out in the future. There's more risk attached to it. Market volatility. If the market is highly volatile at the time of the policy sale, the premium will be higher. If the market is fairly stable, the premium should be less expensive. So this is one that we've seen quite a bit these last few months here is high volatility keeping these premiums up pretty high. Coverage price, same when we go through the table examples, the higher the coverage, the higher the premium typically, and lower the coverage will be lower premium. And then we also use a fixed interest rate throughout the life of the policy, and it's based off of the Bank of Canada Treasury bills. So once we have our coverage and our premiums paid, we'll fast forward to the end of the policy and we'll talk about settlement. So our settlement data, we settle off of the two main indexes here for calf and feeder, Alberta and Saskman, and then we just have the one price index for fed. So for calf and feeder, we get our data from auction markets that we have data sharing agreements with. So we get our data from them. For fed, we use the Canfax producer data or Canfax price data. We only use steer data for calf and feeder just for a volume perspective. And then for fed, we use steers and heifers. A weight range, we use 550 to 650 pounds for calves, 750 to 950 for feeder, and fed, it's finished weight cattle, so anywhere from 1350 to 1600 pounds. There's no adjustments made to the calf weight. That 550 to 650 averages out to a 600-pound steer. For feeder, we do apply a slide to slide it to 850 pounds, and there's no adjustment to the fed. We do drop because we rely on auction market data, and we try to find average price, average kind, average quality for Alberta. We drop the one and two head lots, which can either increase the price or drop it depending on the quality. And then anything that's plus or minus 12% of the daily mean. For feeder, we also drop the one and two head lots, and then anything plus or minus 10% of the daily mean, just to get us to that average kind, average quality. And then for fed, we do have the plus or minus 5% outlier rule. So anything that's plus or minus 5% is eliminated. And then we do have to have a minimum of three producers report a price. So we have to have that for confidentiality reasons. Otherwise, we wouldn't be able to publish a price. And then we use our data collected directly from the local participating auction markets, and we calculate a settlement index each week, published on a Monday using the prior week's sale data. A lot of times, some auction markets don't always get their data in on time, so it will be as representative of the market as we can get, as long as the auction markets have got their data to us. So we have to have the data in by 10 o'clock Monday morning in order to be included. Otherwise, it would go into the historical if it came in after that. For Fed, we use the CanFax reported data from the previous week. That's usually published on Friday. And then sometimes there's weeks where we don't get enough data to publish a value. If there's a light sale week or a storm week where there's not a lot of trade or something like that, we'll have to use a backfill index. So that backfill index would be any late data that comes in, and then a historical price point would come in as well. A historical factor would come in as well to try to estimate what the price roughly was for that week. So going to the next slide, we'll talk about how to use LPI on your operation. So in order to effectively buy price insurance, producers have to make the following decisions. So where you plan to sell the cattle, whether you are in Alberta or if you're in Saskatchewan, Manitoba, um, when the cattle are likely to be sold, what is the coverage level desired, and how many animals do you want to insure, and what would their expected weight be at the policy expiry. So we'll go through an example of how to make a purchase and what the numbers would kind of look like when you're making a purchase. So the first thing is the premium tables we offer are on Tuesdays, Wednesdays, and Thursdays. If a producer wants to purchase on one of those days, it can be completed online or sent into AFSC via paper form between 2 p.m. and 11 p.m. Mountain Time. So in this example, we have an Alberta rancher that's concerned that the market price for their backgrounded calves may drop going into the spring. They calve about 200 head in March and April. They wean their calves at an average weight of 600 pounds. They would background them to around 850 and usually sell at a central Alberta auction market in early to mid-May. And they decide they want to consider LPI to ensure their investment in the cattle. So the first question we ask is where? We have to consider the marketing region of where we're going to be selling the cattle. Now, in this example, the Alberta region most closely represents where the cattle will be marketed. Um, so we have to make sure that the producer is using the Alberta table. If if though you sell, if you're on the border or something like that, where you're going to be selling into Saskatchewan, then that table would be more reflective of your market. But there's nothing to say that you can't use, if you are an Alberta-based producer, you can use the Saskman table. If you're up Saskatchewan, you can definitely use the Alberta table. There's nothing to stop you from buying those regional indexes. They just need to make sure that you just need to make sure you're following the right table that you're wanting coverage on. So in this example, the Alberta region most closely represents where the cattle will be marketed. Next, we need to consider the marketing time. So if the producer plans on selling calves mid-October and then backgrounding them, they want to choose the 28-week policy. I think this should be 16 weeks. Sorry about that. But so the first claim week we're going to sell in May. Sorry, that's my mistake. We're selling in May. So the first policy length we would choose would be the 16 week, and we'd want these would be the dates that are important. So when we look at the table, we'll see that the expiration date would be May 18th. Um, but you always have 3 weeks ahead of your expiry to claim early. So if you see that you're in a payment position um, at the end of April and you want to claim early, you can do that. Or if you can also claim each week. But you have to note that you do have to manually make these claims in the early claim window. Otherwise, it will auto claim on the final week of your policy. So in this example, the producer is looking to insure against a market decline. So they've calculated their break even, which is around 450. And then they want to also protect the underlying value of the cattle. So that, at 450 weight on an 850 pound steer, that works out to about 3,800 bucks. So when we look at the table here, we have on the top our insured index. So this is the top coverage available for the 16-week policy. It's 464 is the top coverage. The premium there is $10.24. And we know that we're looking at the 16-week policy expiry May 18th. So then we need to decide how many. So we want to consider what the expected weight would be at the sale time. So in this example, the producer wants to insure all the cattle. So he's going to take 200 steers times 850 pounds divided by 100 to get 1,700 hundredweight of insured weight. LPI operates in dollars per hundredweight instead of dollars per pound, so just keep that in mind when you're doing your calculations. So we then have to look at what the cost is for the policy um, to determine which coverage they want. So they want to buy the top coverage of 464 on 1700 hundredweight. So they take that $10.24 a hundredweight, multiply it by 1700 hundredweight, and it works out to about $17,408 in premium. So just to convert it to premium per head, take the total premium divided by the number of head, works out to about $87 per head. So we'll fast forward. Now we're at the end of the policy here. So in most cases, producers participating in the calf, feeder, or fed products will get a 4-week claim window, unless their policy settles near a blackout date. So there are some dates where we don't get enough data, and those will be clearly defined in the contract of insure, or sorry, the calendar of insurance that's available on lpi.ca. And the producer can review those dates to ensure that they're purchasing for the time that they're looking for. Um, so calf and feeder will get a 4-week claim window unless, like I said, they settle near a blackout date. Hog policies will automatically expire at the end of each month. So there's nothing to do with the hog there. So this example, I just wanted to show what each claim week would look like. So um, this producer purchased for coverage was 464. So the first week of the claim window, this April 27th, we forecast the coverage came in, or sorry, the settlement index came in at 472.26. And then on May 4th, coverage or the settlement index was 468.42. So they are still below the settlement index, so they're not in a payment position. And then on May 11th, um, we had settlement index come in at 460.62, which is below the coverage purchase, so they would be in a payment position on this example. So if they chose to claim early, they would take the difference between their coverage level and the settlement index, multiply it by their insured weight, and they would get a total of $5,746. But they decided to wait and let it automatically expire at the end, and the market did move down a little bit more. So it was 453.29. So same thing, you take the difference between the two, 464 less 453.29, multiply it by the insured weight, and you get $18,207 dollars of indemnities paid out. So if the settlement is below the coverage purchased on a given week, the producer will be in a payment position. If not, then no payment is received, but they should receive the upside market potential if they sold their livestock that week. So the last section here to talk about, I wanted to talk about when to use LPI. So with everything going on in the markets and the world, it's important to ask yourself some questions. So before you decide to purchase LPI or invest in protecting your bottom line, you need to think about what could currency and cattle prices look like when ready to sell. So we're looking at the future. So when we're coming into calf season here, we're starting to calve, when we need to be thinking about what these prices and things could look like in the fall. And I know we're on we've seen really high prices the last couple of years here, and it's important to be cognizant of what things look like going forward at all times to make sure that you're aware of what's going on in the marketplace. Another question to ask yourself is your operation diversified enough to handle downturns in the cattle market without risk protection? So if you're a mixed operation and grain prices are good, but cattle prices are slipping, or the other way around, which we've seen the last little while here, it's important to know that if you're choosing to not use some sort of business risk management for the cattle prices or cattle markets. As well, what level of risk are you comfortable with? So if you're someone that wants to sell, like we saw a lot of this last year, where people were selling cattle early, selling their calves in June and July, in some of those video sales where, they're establishing their price early, try to avoid some of these market moves if there was to be any. But it's important to be cognizant of what level of risk you're comfortable with on your operation. And then what impacts will politics or supply and demand have on the market? So we've seen the last, like that futures chart I show right off the start that shows quite a large rally we've seen from the last few years of having low supply in the North American cattle herd. Um, and it's important to see that that's what's causing it, and some sort of potential some sort of herd rebuild or something like that will could impact the supply, or the packing capacity in the US could change, which we were seeing right now where some plants are closing and or reducing capacity, where that's going to affect the number of hooks available for producers in the States, which will naturally affect the number of will affect our prices here in Canada as well. And then the other important thing is politics. So we're seeing quite a politically charged environment across the world, and it can as a producer of agriculture commodities, it can have dramatic impacts regardless of what happens across the world. It can impact anything. So it's important to be thinking about that when you're trying to make decisions of insuring or not insuring. So when you're going to choose to use LPI to purchase coverage, so you want to match LPI to your production cycle. So if you're a producer who has calves in the spring and sells them in the fall, you want to be making sure you're watching and using LPI to cover that time frame. If you're someone who backgrounds and you want to be paying more attention to the feeder side of things, where you're going to be selling in the spring or in the grass market. So every producer is different. So an LPI is flexible enough to be able to match what you do as a producer. So if you're depending on what you're doing, finishing, backgrounding, or just selling calves off the cow, you're able to match LPI to your production cycle. When you're thinking about choosing LPI, I recommend not just waiting and seeing what the price is. I'd be watching the premium tables, um, pretty consistently each week. So there is an option on our website to sign up for weekly emails for the premium and settlements. So you can be watching these tables every week, um, and making sure that you're up to date on what's going on with price insurance, because when you want to get the best dollar that you can, it's important to be aware of what's going on. So I recommend watching it for multiple weeks ahead of time before you would typically sell your cattle, or watching for the time when you typically sell your cattle, I mean. Next one, ensure you're accurately forecasting weight. So when you're buying price insurance, you need to make sure that you have an accurate forecast. So you would roughly know what weight your cattle would be when you're selling them, um, and or when you're historically selling them, or expected weight. So you want to make sure that you're estimating as closely as you can. There is potential if you don't want to be overinsured if there was an audit or something on your policy, but that there's nothing to say that you don't have to insure all your head either. So if you want to go on the light side just to protect some of them, but if you want to protect all of them, you're more than welcome to do that as well. So that goes to the next point. You can protect some or all of your livestock. And you can also take out multiple policies to match marketing time. So you you just have to have enough cattle to cover all the policies that you have. So if you have multiple policies, like if you sell cattle, like sell your steers in the fall or heifers in the spring or something like that, you can definitely take multiple policies out to match those marketing times. So to kind of wrap this part up, so when you're wanting to use price insurance, you're wanting to protect your operation against volatility in the marketplace. You're protecting the underlying value of the livestock. So whatever you purchase for coverage for your LPI, that's the bottom of the market for you. That is your floor price, and anything above that is yours as well. But when you have LPI, you know that there's nothing that's the bottom for your operation. You can manage risk of falling prices. So when you have an LPI policy and you see the markets kind of going down in the fall, or depending on what's going on in that time of the year, um, you can you can protect yourself against that risk. It's simple and easy to use. There's an online portal where you can do all your purchasing. Well, I'll show you some. I'll show you the links here afterwards of where to go on the website for that. It's market driven, so it stays up to date on current market conditions. Like when we rate 3 times a week for premiums, it stays up to date. Coverage is based on current market conditions, so like I said, we take into account those factors, the price and currency and basis each week. Um, and then it provides a floor price for your livestock, and it provides coverage for all three of the main risk factors present in the Canadian cattle market. So the three programs, CAF will be available starting next week on February 3rd will be the first week we offer CAF for this year. It will be available till the second week of June. Feeder is available year round, except for a few blackout dates. We don't sell it we typically don't see a lot of volume on the feeder side of things selling in the summer time, so we don't offer it early July, or for early July expiry, but around August timeframe you'd see more volume that way. And then Fed is available year round as well. So I wanted to go through some resources here before we end. So when you want to purchase a policy, the easiest way to do that is to get a subscription. So it's quick and easy online. There's no obligation to purchase a policy. You just go to lpi.ca, create an online account. And if you don't have web capabilities, you can familiarize yourself with the paper purchase procedure. And if you have any questions on that, please stop in or call your local AFSC branch office. Um, you want to watch the premium tables, so sign up for the daily premium and settlement emails and look up premiums on specific days on lpi.ca. There's on lpi.ca, we have the apply now, so that's where you can apply for a subscription. You can also get other forms. So if you are new to AFSC and in general, you can apply for your AFSC ID number, apply for your subscriptions for LPI or any other insurance product. You'll need to complete a personal information form as well. And if you need a third-party authorization form for that as well too. For clients new to LPI, you just need to fill out your application for subscription, either paper or online, and then a third-party authorization. And then if you're using LPI for the purpose of a cash advance, we do have the assignment of indemnity form as well. You can send your filled out LPI forms to the local branch office or to the LPI service center by email, fax, or in person. And then I recommend going to lpi.ca. There's some really good information there. So there's the LPI program guide, which goes into depth a lot of what I talked about today, and a bit more detail of things like that. You can review the contract of insurance under the LPI forms, to make sure you're meeting all the eligibility requirements for that. You can find the link to log into the LPI portal. There's phone numbers on the website to talk to your local branch office or to find your local branch office if you're not aware. We have market information, so that one slide I showed that showed our feeder settlement index, that's available for each week for any producer that wants to have a look at it. So you can go to the market information section there and look at the Fed feeder and calf data. There's LPI policy workpad you can use. That's a great resource to play with some of the numbers and see if it makes sense for you, as well as the calendar of insurance so that you know what days LPI is offered. So yeah, that's what I have. Does anyone have any questions?
So there was a question in the chat, Brett.
Okay.
Shannon was asking, what would happen if you took coverage on feeders, but then sell them at a much lower weight? Would that trigger an auto claim? How does AFSC prevent over-insuring?
Yeah, so it just comes down to forecasting your weight. So when you sell, if you were to buy a feeder policy and you wanted to sell, if you wanted to insure a 600-pound steer on the feeder index, you would just if you wanted to do that, you'd want to make sure that you have enough total weight. Not doesn't matter what the weight of the individual livestock are. You just want to make sure that you're insuring enough total weight. So if you're doing 600 if you're doing 600 pounds, right? Yeah, 600 pound steer times um let's say you want to do 50 head of six weights, right? So 60 times 50 or sorry, 600 times 50. So you have 30,000 pounds you need to insure divided by 100. So you just need to insure 300 hundredweight. And that doesn't matter if it's on the feeder program or the fet or the calf. You just need to make sure you have that total hundredweight that you're insuring. Doesn't matter what index. Hope that answers that.
Sounds like it.
Okay, perfect.
Any other questions for Brett before we go? I don't see anything else in the chat. Raise your hand or unmute if you've got something as well, but okay, well, if anything comes to mind, just let us know and we can put you in touch with Brett, or like he said, the website's a good place for extra resources as well. So with that, I guess we'll say thank you to Brett and thanks for joining us today. That was very informative.